I'm Peter White. Welcome to the Inside Network. Welcome to INDepth. I'm Peter White, and my guest today is Pete Robinson, who's Head of Investment Strategy at CIP Asset Management. Pete, welcome.
Thanks for having me.
What's the most important factor when assessing valuations in private lending? Is it public information, or is it what you do behind the curtain? How do you go about it?
Look, I think it's a whole range of things. One of the great things about private lending is the access to information you can get. So it is about looking at public information, but it's much, much more than that. So when we go in and we look at a private borrower, we'll sign a non-disclosure agreement, and that enables us to get behind the wall and see all the information that you wouldn't get to find in a public company because of public disclosure requirements. And so we'll go in and we'll talk to that borrower and say, we want to know everything about your company that is going to affect your ability to repay our debt.
How often does the public information not align with what you find behind the wall or behind the curtain?
Yeah, it's not so much that it doesn't align, but understanding the rationale that management provides for public information and then digging behind it to find out what's actually going on. We've got a lot of that going on with the Greensill situation right now. Understanding what's driving a company's working capital needs and how they're financing those needs is something that you really need to get behind the curtain on, and we think that that's extremely valuable. The other thing that's really important is getting access to that information in a really timely fashion. So rather than waiting on semi-annual disclosures from the company, from a public perspective, getting behind and seeing that information in real time is crucial. And it was particularly crucial in March and April of last year.
Well, you referred to the Greensill situation. Is that a surprise to somebody like you and your organisation, or not?
Not really. I think it's been public for some time. Certainly we've been amongst many investors in the public markets who've been quizzing companies like CIMIC on their use of these styles of financing. The AFR has done some terrific reporting on it for some time. So the risks inherent in supply chain finance and some of the accounting nuance of that has been well known by the market for some time.
What's your approach to portfolio construction once the credit has been valued?
Yeah, I think in private markets this is something that often gets overlooked. But for us at CIP Asset Management, we're really focused on that portfolio construction piece. So the first thing we do is we assess the relative value of that position in its own right. So essentially looking at the return we're getting for the risk that we're taking on in that position. Then we overlay both industry, sectoral and thematic considerations and see how that position fits across the whole portfolio. For example, right now we're really thinking about the impact of higher interest rates and the impact of withdrawal of fiscal stimulus across our portfolio.
Can you compare the risk profile of your lending versus other strategies in the market?
That's a really difficult question to answer. And one of the reasons why it's difficult with private lending strategies is there's a whole range of approaches around the rating of the underlying investments. So at CIP Asset Management, we really try to bring transparency to that process. We have an independent credit risk function that independently assesses and rates every investment using a consistent methodology to what you would find in public ratings. And so that gives our investors confidence and comfort that they can understand the ratings of the underlying investment and the credit risk profile of the fund. The other thing we try to do is we also provide information to our investors on both a line-by-line rating of the portfolio, but also a default risk-weighted average rating of the portfolio so they can assess the risk of our strategy against other strategies that are out there in the market.
Is that common to your peers as well or not?
It's not particularly common, and I think one of the challenges in private markets when you're dealing with investments that aren't rated by an independent third party or credit rating agency is how you develop consistency across those assessments of risk.
Your portfolio, of course, is mark to market.
Yes.
Can you just explain that for the average potential investor?
Yeah, really when you say mark to market, what you're trying to do on an investment is arrive at a valuation which reflects where a willing buyer and a willing seller would trade at a given point in time. In the absence of trading information on that individual investment, what you do is you compare the trades in other investments of a similar risk and liquidity characteristic. That's really what marking to market is. We think it's crucial across all of our strategies to mark to market. It was particularly crucial in March of last year, where you wanted to reflect the underlying level of risk in people's portfolios. It's important to be able to assess from a portfolio construction perspective how a private lending strategy may be performing against a public strategy, against other private lending strategies, and even against equity strategies. So we think it's crucial, but it's crucial in the assessment of the underlying strategy in its own right, but it's also crucial in the assessment of the underlying risk return objective of the fund. We find that by imposing a mark-to-market discipline on our portfolio managers, they demand a higher return on new investments to reflect the higher level of credit risk that is in the market at that particular point in time.
Is mark-to-market the industry standard, or are you more unusual in what you do there?
I think for alternative lenders globally, it is the industry standard, and certainly in Australia, I think it's becoming more of a standard. There are a lot of independent advisory bodies, and they have recommended approaches, all of which really recommend marking to market on credit portfolios.
We're hopefully coming to the end of a pandemic, but we certainly have been in the middle of it. What effect, if any, has the COVID situation had on your business and what you've done during that period?
So what's been really interesting is how much monetary and fiscal stimulus has been thrown at the problem both in Australia and globally. So we haven't really had a credit cycle. At CIP Asset Management, we've probably had the most benign credit performance across our portfolio since we started in this business of private lending back in 2005. Which is a staggering thing to say, looking back at where we've come from since March.
And some observers have said that capitalism has been suspended.
Yeah, I think we've pressed pause on capitalism for a short period of time, and that intervention was timely and very, very effective. But where we sit today is that we're now at the point where the tide is going out. So this stimulus is starting to be withdrawn, starting with the ending of the JobKeeper allowance program, the ending of the Term Funding Facility in June 2020, and Scott Morrison being very explicit about his intent to withdraw some of this stimulus that's been supporting the market over these past 12 months. And we think that credit cycle is really just going to start in 2021 and 2022. So the next couple of years are going to be quite interesting.
What about the impact of the Biden $1.9 trillion stimulus? How much is that going to flow through, if at all, to what you're doing here in Australia?
Well, look, I think what we've seen with interest rates globally has certainly had an effect in Australia. We're all tied to the US ship in some respects, and certainly the level of the Australian dollar will be impacted by that. And what we see is that when credit spreads widen in the US, credit spreads will widen here. That will happen. These markets are connected. So as that stimulus is deployed, I think we'll see inflationary pressure in the US, and that may spread to Australia.
If public markets are selling off, what does that mean for private markets where you operate?
So for us at CIP Asset Management, we talk a lot about the illiquidity premium, and that's the additional return you get for taking the same amount of credit risk on an investment, but additional liquidity risk on that investment. We always want to make an excess return over and above the return that we would get for just taking on credit risk when we go into private markets, and we call that the illiquidity risk premium. Typically, we'll target around a 2% annual excess return for taking on that liquidity risk.
Have you been able to maintain that during the COVID period?
Well, what happens when public markets sell off is you tend to find that private markets lag. And so most of our activity last year was actually in public markets, because what we found was that illiquidity premium was compressed and it even went negative. And for us, what that means is that's a signal for us to go into public markets, invest our capital in those markets, and then as those liquidity premiums normalise, sell the assets in the public market for a gain and rotate back into private markets, which is what we're doing now.
Talking about that period, how would you summarise your track record during 2020 from your own business point of view?
I think everyone had a similar experience in 2020 because of all the stimulus that was thrown at the market. So we had corporate bankruptcies at a very low level, much lower than even they were in the years prior to 2020. So I imagine everyone's telling a similar story, that performance was really strong. We now sit here in March of 2021 with credit spreads lower than they were when we entered the pandemic. So I, like many others, will be telling you about our great performance. What I think is important to note, though, is how we're positioning ourselves for the years to come. And as I said earlier, we think that there are going to be some tougher years ahead as that stimulus is withdrawn. So we're really positioning ourselves conservatively as we look forward into the coming years.
And being conservative, what does that mean on the ground for a potential investor in your products?
I think what's crucial in our products is getting the leverage right out the gate. So a business that has performed well in 2020 has outperformed its budget, has outperformed what it did in 2019. We're not pro-formaing that earnings profile into a higher multiple and assuming that that's going to be the case going forward. So we're really focused on getting the leverage right on companies at this point in the cycle and not over-leveraging companies at a point where we think that stimulus is going to be removed.
So for investors looking to get into private credit for the first time, what's your message?
I think ask questions, try to get through the shroud of complexity that exists within the market and really understand the asset class, the fundamental drivers of the opportunity set and its key risks. We think governance is a pretty boring topic. Every credit manager talks about it when they assess the bottom-up fundamentals of the company they deal with. They hold management to account. We think investors should hold investment managers to account when it comes to governance, and that's particularly true in private markets where there is a lack of transparency and an asymmetry of information between the end investor and the investment manager making the investments.
How can your market be better understood by the mum and dad and the SMSF investors? I think instos know what's happening, but is there any tips or advice to people thinking about investing in private credit for the first time?
Well, I think there's a greater availability of product that's coming to market, which is really healthy. People can assess, the different strategies that are out there and make an assessment of the risk return and what works for them. I think what's really, really important is for investors to look at a really broad range of strategies and understand what the different managers are doing. There is a huge range of alternative or private lending strategies out there. So the best advice I can give is to get as broad a perspective as possible.
Pete Robinson, thanks for talking to us today.
Thanks for having me.